I now hand the conference over to Ms. Ruchi Rudra, Investor Relations Officer, Chalet Hotels. Thank you, and over to you, Ms. Rudra.
Good morning, ladies and gentlemen. Welcome to the Q3FY21 performance call for Chalet Hotels Limited. We have with us Mr. Sanjay Sethi, Managing Director and CEO, and Mr. Milind Warekar, our Interim CFO, to take you through the performance and respond to your queries. Let me make the usual disclaimer on forward-looking statements. Kindly refer to our presentations for the details of the same. I hand over the line to Mr. Sethi to share his opening remarks.
Thank you, Ruchi. Good morning, ladies and gentlemen. Thank you for joining us for our quarterly earnings call for Q3FY21. Our performance presentation has already been made available on our website and on the stock exchanges, and I hope you've had a chance to go through the same. Over the last few months, there have been several positive developments from the vaccine to the general state of the economy, with special pace pickup in the last few weeks. Government of India has successfully administered well over 5 million doses to healthcare and essential workers as the phase 1 of the drive picks up. And across the globe, this number has crossed 124 million vaccinations mark. Both very good numbers, better than what was expected, say, 3 months back. The average daily new case count in India has dropped to circa 12,000 cases per day, with improved recovery rates, and these numbers are trending in the right direction. There seems to be some form of herd immunity settling in India. A recent Sero survey in Delhi indicated 1 in 5 residents have developed antibodies to the virus. Mumbai numbers are expected to be better. With this backdrop, we're witnessing improved public sentiment and confidence as increasing numbers of domestic and global companies are scaling up operations and have commenced some form of work travel, though cautiously. Project-based travel has already picked up. The same can be seen as the domestic air traffic load is constantly growing. For the quarter October to December, domestic air traffic grew by 113% as against the previous quarter. The Finance Minister last week presented a strong budget targeting economic revival with special focus on infra spend, higher FDI and insurance, bad banks to manage NPAs, and stable tax regime generating further tailwinds for our sector. Several state governments have been lifting restrictions in a staggered manner across the country, which augurs well for the hotel business across travel, F&B, and MICE. We continue to work with the government on furthering the cause of travel and hospitality industry. In fact, the state government of Maharashtra has taken some bold steps to alleviate the pains of the industry. And through multiple meetings with the Honorable Tourism Minister, we've been able to get the following. We were able to get the opening up of the restaurants and banquets sometime in October, when we were really struggling at that point of time on the F&B side. We've got a 3-month waiver on property tax for hotels that housed doctors under the kindness package. We got a 6-month waiver on excise fee. And finally, the much sought industry rate benefits for electricity, water, and property tax, something that we've been chasing since 1999. This will become effective 1st April of this year. With Maharashtra as a benchmark, we're working for similar initiatives being rolled out in Karnataka and Telangana, and we have some progress in both states already. On the business front, we've clocked a strong sequential improvement across our portfolio. On a consolidated basis, we've recorded a positive EBITDA of rupees 169 million for the 3 months ending December 31st, 2020, led by improved revenues and key initiatives on the cost front. The hospitality business revenues grew by 74% sequentially on improved occupancies from 19% in September to 26% in October, 33% in November, and 39% in December. The RevPAR also saw 105% growth from September to December, as given in slide 6 of our presentation, driven by increased focus on long-stay, large corporate bookings, field crew, and project-based business. We also had very good success with the staycation part of this business. With a 337% jump in F&B revenues from September to December, food and beverage division's share has improved to 42% within the segment and the quarter's revenues from a 26% in second quarter. This was an outcome of easing of restrictions in F&B by the state government in Maharashtra and Telangana and Karnataka, increased social functions and creative revenue streams by the hotels. We are getting weekly updates on extension of timings for restaurants, bars, and banquet facilities and reduced restrictions on persons for banqueting functions, thus building confidence on ending this financial year on a better note for F&B. On the cost front, I'm happy to share we have successfully maintained approximately 50% reduction in fixed costs for this year thus far, and backed by exhaustive cost control measures undertaken since the beginning of the year. We've also been able to get 74% reduction in our variable costs. You may refer to slide 9 of our investor presentation for more details. Significant part of the fixed cost savings is likely to be permanent in nature. For example, our staff room-to-room ratio as of December 2020 was 0.73 employees per room against 1.18 in December of 2019. This will see some increase as hotel occupancies scale up. We expect this to be around the 0.9 employees per room mark in stable business scenario, including contract employees. Payroll costs are now 28% of revenue versus 64% in Q1. Working on the core principle of effective operations and cost management, we have fortified the centralization of business functions. We concluded centralizations of the finance department for all hotels run by Marriott for Chalet. We've also concluded outsourcing of the laundry of 2 large hotels in Mumbai at Sahar and Hawaii. On the retail and commercial portfolio side, the rentals for the assets continue to be unaffected in this quarter and provide a steady cash flow. On retail front, for example, we are seeing pickup in footfalls in Inorbit Mall in Bangalore. For the Orb at Sahar, which has been lagging in pickup due to the pandemic, driven by the fact that we had restaurants over there, we are currently re-strategizing the space for a potential commercial office. We envisage a higher demand for grade A office assets in the market, providing stable rental yield for our business. The idea being that we re-strategize wherever we see trouble, and right now we see a strong opportunity on office space. We've already had initial inquiries which are strong. On quick update on our project pipelines, as discussed in the last call, we started work on the 2 commercial development sites at Renaissance Complex in Powai, in Mumbai, and the Marriott Complex in Whitefield, Bangalore, with cumulative 1.2 million square foot of leasable office space. The work is progressing at full pace, and these assets are expected to be revenue generating by FY23 for Powai, by end of FY23 for Powai, and end of FY22 for the Bangalore asset. The lobby renovation at Renaissance has been completed. The new lobby has been operational since early January 2021. We've had excellent feedback on the renovated lobby. The balance renovation of the hotel will be undertaken in phases. We are currently reviewing demand dynamics for the Hyderabad market and assessing the same for opening the new hotel. The pending work on site is expected to take approximately 5 months for completion from the restart date. Similarly, the need for commissioning additional 88 rooms at Novotel will be reviewed on an ongoing basis and executed at opportune time. Given the current occupancy trends at Novotel Pune, we may take an early call on taking this forward because the hotel is already back to between 65 and 70% occupancy. The 2 new hotel developments at W at Powai, Mumbai, and Hyatt at Airoli, where the work is yet to commence, have been put on hold till we have more clarity on pace of demand before we commit capital to these projects. Ladies and gentlemen, the past year has been a learning curve for all of us. I think we are coming out as better and more efficient company. I'm optimistic of improved visibility on the business environment in the coming months and normalcy to return shortly thereafter. I also believe that the moment the foreign travel, business travel visas get permitted, there will be pent-up demand and a lot of travel will begin, especially to the hotels in Mumbai, Hyderabad, and Bangalore. I now hand over to Milind to take you through some of the key numbers for the quarter.
Thank you, Sanjay. Good morning, ladies and gentlemen. I hope everyone is healthy and safe. There has been an improvement in business sentiments and in personal and business travel over past few months. Restrictions are being relaxed across several states. Positive developments in budget and stable interest rate environment give us better visibility of normalcy. Let me give you some insights into our financial performance. Sequentially, Q3FY21, total income has grown by 43% to 916 million, and EBITDA for the period higher by 139 million at 169 million as compared to Q2FY21. Led by our cost management initiatives, we have been EBITDA positive at entity level throughout the pandemic. At PAT level, that is post charges on depreciation and interest, for the company was negative of 310 million as against negative of 427 million in Q2 of this year, a sequential improvement of 117 million. Hospitality. The hospitality segment contributed to 68% of total income of the company in Q3FY21. The revenue grew by 74% on sequential basis to 625 million, with positive EBITDA of 20 million for the quarter. Occupancy for the quarter averaged at 33% and RevPAR at 1,318 as against 1,007 in Q2FY21, a growth of 31%. Food and beverages division performance has picked up, with contributions increasing to 42% of hospitality revenues. On the cost front, as mentioned by Sanjay, the company has achieved fixed cost reduction of approximately 50% as compared to previous year, consistently since March 2020. The fixed cost for 9 months has been at average of 11 to 12 crore a month, and the fixed cost is expected to be largely static going forward. Variable costs have been down by 75% for the period. The variable cost expected to rationalize as operations scale up. Total expenses for the quarter were lower by 57% as compared to the previous year and were higher by 30% as compared to Q2 FY21 as operations scaled up. Retail and commercial. Steady rental income from commercial assets have kept the revenue and EBITDA from retail and commercial segment at 226 million and 168 million for the quarter respectively. As mentioned by Sanjay, we are re-evaluating the strategy for the op at Sahar, Mumbai for potential office space and hedging the portfolio further. 9-month FY21. For the first 9 months of the year, total income was at 2147 million. Total expenses for the period were at 1944 million, a drop of 60% from the previous year same period, and EBITDA was at 202 million. Treasury. Net debt of the company as at 31st December 2020 were at 18,110 million as against 16,570 million. That is 1811 crores against 1657 crores. A total increase of 154 crores for the period. The capex spent during 9 months FY21 was at 72 crores. Our cash burn That is EBITDA less finance cost for Q3 FY21 has been at 205 million, while for the year to date December 2020 has been at 966 million, led by prudent cash flow and working capital management. The average cost of rupee loan is now at 8.30. And here I would like to add that 52% of our rupee loans are at sub-8 interest level. With the reduction in interest rate effective from 1st January 2021 by one of our lenders, average cost of rupee loan is expected to be in the range of 8.05% in the next quarter. I am glad to additionally share that we have received in principle approval from International Finance Corporation IFC for the term loan of approximately $50 to 75 million, subject to due diligence. We expect a sanction from HDFC Limited for 500 to 600 crore in next few days. These are expected to be utilized for capex and long-term working capital requirements of the company. We have cash and cash equivalent of 634 million as of December 20. Further, we have undrawn lines of credit of 1403 million for general corporate purpose and 922 million for capex. Koramangala, there has been no new subscription from the promoter to 0% non-convertible redeemable preference share for funding the outflows relating to the residential project. With this, we now open the floor to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. The first question is from the line of Aditya Bagul from Axis Capital. Please go ahead. Aditya Bagul, your line is in talk mode. May I request you to go ahead with your question, please?
Sorry, I was on mute. Hi, congratulations, Sanjay and team. I think reasonably good performance in a really challenging time. Sanjay, my first question is to you. Just wanted to understand if we could give some texture in terms of our occupancy, which is there in December and Jan. I see December was close to 40% and Jan was 37%. So can you give us some texture as to what is the composition of this occupancy? What is retail, business travel, crew, MICE? If you can just help us understand what is the composition there.
Sure, I also ended up being on mute. I hope you're doing well. Yes, so look, we've been seeing constant increase in occupancies. It's almost weekly improvements now, which is a good sign. And I think it's 2 or 3 things coming into play. One, our ability to cater to the staycation segment has improved significantly. Number 2, because we develop products to cater to that segment. 2, we continue to garner a significant part of the special purpose group business. The cruise liner business, the one-day Bharat business, etc., in various hotels. But more importantly, I think we now see corporate travel pick up, and which is very, very encouraging for us. To begin with, it was project-based corporate travel. We now see some individual travel also starting off. And just to give you a flavor of what's happening, and then I was looking at the top 5 corporates that are using us in the last few weeks at our various hotels, and I think this will be helpful for everyone, so I'm going to take some time over this. So for example, in 4 points, we see Reliance, we see IKEA, we see Eber Particles, we see McKinsey, all using our hotel. And these are just the top 4 or 5 people that I'm talking about. There are many more. And in January, just these top 5 have consumed about 1,000 room nights. And similarly, in quarter 3 gone by, we had similar sort of accounts with a couple of extras that were there. Western Hyderabad in the quarter 3, for example, we saw DPP Aviation, BCG, Wells Fargo, Microsoft, M3 Aviation come and use our hotel rooms. Similarly, at Sahar, we got Samsung, BCG, NetMagic, Accenture, McKinsey, all of them taking up rooms in our hotel. Novotel saw Mutual Automotive, NXP, Honda Motorcycles, Procter & Gamble, Bajaj Alliance. Renaissance has seen HP, Applied Materials, Alstom, Schneider, Cisco. So what I'm trying to convey with this is that, and then Bangalore, Whitefield, and we see Novo Nordisk, Sun Mobility, GE, NextGen, Winstrom, and Apple. Now, what I'm trying to communicate with this is that there seems to be confidence building up on business travel. And a lot of this may be project-based business travel, but if project-based business travel is happening, at least the confidence in travel is happening, and individual travel will follow. As you know, we are right now handicapped with a no visa rule for business travelers from abroad, unless they are coming here for specific project-based business, in which case special visas are issued. And the moment that opens up, I think there will be an opening up of floodgates that will happen. But to sort of summarize the question that you asked, I think it's a mix of everything. Staycations continue to be strong. Project-based business continues to be strong. We are now seeing some small conferences happening at hotels, some amount of wedding groups, but all of it heading in the right direction.
Perfect. That's quite helpful. My second question is actually related to what you said recently. So in terms of the occupancy, if you try and bifurcate that across the segments that you provided in the PPT, Bangalore and Hyderabad continue to be under pressure. So is there something to read into that, especially given a lot of IT guys are now transitioning into more of a structural work from home regime? Is there a cap to the occupancy that you see?
So look, in the recent months, I see Bangalore, for example, picking up on occupancies, and that's clearly an indication that people, even in the IT industry, there's no other business there in Bangalore actually, and in our Whitefield area at least, are traveling now. And you got to remember that 70% of our business used to come from outside India earlier, the high 60s. And that's, as I said, the moment the visas open up, I see a rush of business coming in. On the work from home front, yes, there is a challenge. We've got the Mindspace Business Park around us in Hyderabad. The occupancies of that business park continue to be low. And the moment the people are back, we will see business coming again. And, an indicator for us from our perspective is that the office spaces around Whitefield, Hyderabad, Hawaii, and even in Navi Mumbai are not getting vacated. So unlike the earlier assumption that there will be vacancies created because of work from home from office spaces, we don't see that happening around us, which means the corporates believe that they will need those spaces in the near future, and they're holding on to them, and they will come back to work from office very soon.
Sure, that's helpful. Two quick questions from my end. One is, we've not seen any material renegotiations either from WPP or Accenture. Is my understanding correct?
No, look, no renegotiations, except there were certain variable costs that we were charging Accenture, for example. Like there was a fixed cost that we should charge them for tea coffee service in their office not being used. There was a certain service cost that we were charging them. There was a certain number of maintenance costs, a CAM charge that we were charging them. Now, because those are not there anymore, to that extent, we gave them some relief. And on the rooms that they're not using, we gave the variable part of it was given a small amount of relief, but that's really very small numbers. At the WPP, which is a larger number to work with, there is no rent relief that they have sought. They have sought relief on CAM charges, which we were happy to give out because we had reduced the cost there, and whatever the cost saving we had, we passed on to them. The other ask was to waive off the parking charges, which also we gave them for a certain period of time. But now from January onwards, both the parking charges and the camp charges will be normalized.
Sure, that's helpful. One last question to Milind. Sir, can you just help me understand what is our debt repayment schedule for 22 and 23?
Our debt repayment for next 2 years will range between 250 to 275 crores. And for the next quarter, that is Q4FY21, it is 41 crore rupees.
Right. So, sir, 41 crores for Q4 and 250 to 275 crores for 22 and 23. Is that correct?
That's right.
Perfect, sir. Thank you so much. Best of luck for the quarters to come. I have more questions. I'll come back in the queue.
Thank you, Aditya.
Thank you. Ladies and gentlemen, you may press star and 1 to ask the question. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. So will it be possible to give revenue contribution from the wedding segment during the quarter, given 3Q had a lot of wedding dates, which is not in the case in the current quarter, or it would be lesser revenue?
Hi, good morning. This is Sanjay here. So we will share that with you. We don't have that as ready data right now. We'll be happy to share that if it's possible in subsequent to the call.
Sure.
Just to give you a sense, we had about 250 social functions in Q3. So with the 90-day period, we roughly had, about 3.5 or 3 functions a day in our hotels every day.
And how would be the bookings for the current quarter comparative to this?
January wasn't strong because January didn't have the auspicious days. But going forward, right up to June, there are several auspicious days, so we see that continue to pick up. And with the increasing number of people being allowed for weddings, it will only get better. So we have Hyderabad and Bangalore, and we are on a special case-to-case basis. Even Maharashtra is giving approvals, but the organizers have to go and seek approvals for that. And we expect that in the next 2-3 weeks' time, Maharashtra too will ease off that 50 people cap, the cap on the wedding functions.
So that was really helpful. And sir, on a like-to-like basis, when the quarterly revenue for the hospitality portfolio is back to pre-COVID, what would be the like-to-like quarterly EBITDA which you would see? Because, what I'm trying to understand is because of better efficiencies along with benefits given by the Maharashtra government, how much your EBITDA would improve on a comparable basis? Will it be possible to quantify?
Amandeep, Milind here. We have internally analyzed expected reduction under 3 major cost trends, which is coming from this Maharashtra government notification. One is property tax, another is water charges, and major component is electricity. So electricity expenses are expected to reduce by around 25 to 26% of our Maharashtra portfolio, and property tax and water charges somewhere in the range of 28 to 30%.
So, Amandeep, we don't want to give exact numbers right now because they will become forward-looking statements, but this is the difference between industrial rates and commercial rates that we are sharing with you, which is in public domain. But it will give you an indication of how the savings will pan out. As I said earlier, it is a long-fought battle. It took us 22 years to get here. And we're grateful to the government of Maharashtra. Me and a couple of other industry colleagues have met the Honorable Tourism Minister 4 times, and every time we met him, we managed to get something out for the industry from him. It's been a very, very fruitful engagement that we've had over the last 3 months.
Sure, sir. That's helpful.
And there's more to come. We're still working on other stuff.
Okay, sir. And sir, with increasing...
Sorry to interrupt you. Sir, may I request you to keep the mic a little away from your mouth?
So, is it better now?
Thank you.
Yeah. So, sir, with increasing focus on the domestic segment, where the LNR, that is locally negotiated rates, are usually lower than the RFP with global accounts, will it be fair to assume that it would take much longer time to reach pre-COVID ADRs rates despite occupancies coming back due to the change in business mix?
So yes, as the segments change, we do expect, Amandeep, that the ADRs will, move around. But at some point of time when the occupancies do reach that, the 70 and beyond, we were at 75 pre-COVID, we don't see the mix changing too much. We do expect our foreign traffic mix to come back to more or less near normal numbers. May not happen as it immediately are broken out, but over a couple of quarters that will stabilize. At that point of time, I don't see a challenge on the ADR front. However, I think what we've done, and this is important for everyone to understand, this pandemic has sort of forced us to innovate and create new segments that become now segments available to us for good. And in our business, we always have peaks and troughs of occupancies, whether it's weekend and weekday variants, whether it's holiday season variants, whether it's summer and winter variants. Now we'll be able to leverage and revenue manage the new segments that have been created, blend them into the existing old segments, and probably get far better revenue management in place and RevPARs in place.
So, sir, that was all from my side. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Thanks for the opportunity. The two questions which I have. Firstly, January is the time when you renegotiate with the corporate. So, firstly, have you done that? And in this case, have there been any increases? Or what's the outcome of that? Secondly, coming to your points you mentioned in the initial remarks about the capex on W hotels being limited. So what exactly is the strategy going forward? I mean, the new hotels you plan for are kind of in complete shutdown mode, or is there some kind of plan still on for it? What I want to understand is the strategy as we move ahead in the longer term scenario. Yeah.
So, Amit, I'll take these questions. Regarding the rate negotiation, the cycle actually begins in September, October for the calendar year basis, January to December. Look, it's been very, very uncertain times for everyone. I don't think the corporates have focused too much on rates. They have agreed, almost all of them have agreed to carry forward previous year's rates. So there is no downward negotiation as far as the global RFP accounts are concerned. So when they do come back traveling as FITs, we expect the rates to be similar as pre-COVID times. On the LNR accounts, they're because we've strengthened our focus on LNR accounts. There have been new negotiations that have happened, and we do expect those rates to be, newly negotiated rates in a new environment, and therefore there may be some movement on the rates. Overall, as I said earlier, once the stabilization of foreign business travel and domestic business travel happens in India, rates will be back to largely the pre-COVID numbers, and I don't see a variance. To address your question about strategy on the development pipeline, it's like this. We've realized through the pandemic on 2 or 3 things have happened. One, we found retail to be extremely, volatile. So from that perspective, especially restaurant retail business to be extremely volatile. So at all, where we were proposing to have 28 restaurants, 16, 17 of them had already opened pre-COVID, we've seen a lot of stress over there with those owners who are on leases with us. And some of them may fall off. With that in mind, and being agile to the situation, we have re-strategized, and there seems to be in that location a steady demand for A-grade office spaces. So we are now mixing up the org as a mix of F&B and office spaces, thereby de-risking the business for the future. The demand that we've had seen in the last 3 or 4 weeks since we took this call is very, very strong. The rental rates continue to be as per the market numbers pre-COVID, so we see no reason why we should not go down this path. On the hotels and the other 2 office assets that we were developing, the demand again in those 2 specific locations for grade A office space is very, very high. So therefore, we decided to recommit capital to those 2 assets, and we started work a few months back. We've got significant amount of people on site working towards finishing it as per the dates that I shared with you earlier. On the hotel side, we had 3 hotels, and I did cover this in my opening part of the conversation. There's a Hyderabad hotel, which was, the structure was up, largely built. It's a shell lease, and the fit outs had started. We're only 5 months from completion from the day we start work on site. We will review this in early March through an in-depth analysis of market demand 6 months later. For that category of hotel at the price point that we are looking at. And if that continues to be strong, we will start work in April and open it out by September. It will do 2 things for us. Number 1, it will create a beginning in this coming financial year, add inventory, and secondly, it will give us an opportunity to bid for the next year's RFP rates, which, as I said, are done in September, October, so we'll be ready by January with RFP accounts in place. The other 2 hotels, which is the W in Powai and the Hyatt Regency in Airoli, we had not put shovels in the ground. Given the current demand situation, we are not in a rush to commit capital to it. We will watch it very closely. My best case estimate is that we'll probably start Airoli earlier than the W in Powai because we already have 773 room inventory in Powai. And we see Navi Mumbai scaling up pretty rapidly with the 5G program, the airport work happening rapidly, the metro expansion happening rapidly, and the Trans-Harbour link coming up very, very quickly. In addition to that, Mumbai and Pune corridor is getting built commercially and as a residential usage very, very rapidly. So with that strategy in mind, I think by middle of this calendar year, we'll take a call on Airoli and maybe start work 3-4 months from then, but that all depends on what the call is made. W is an open discussion right now.
So, last question from my side, if you allow. This is more on the overall room supply ratio, demand supply ratio. I understand from what I've heard from other hoteliers that because of pandemic, there's a possibility that some of the branded room supply might have gone down. Firstly, do you agree with that? And secondly, do you expect that once normalization does happen, that will go in your favor? And on this point itself, if the distressed assets in the market, are you bidding for it?
Okay, Amit, I'll try and answer all those three questions you've asked me. On the room and demand supply situation, yes, the expected new supply is expected to wean off. We know of specific projects that have dropped off. We know some projects which are large in nature, they are now sort of hedging their risk by doing mixed use like we've done in the past, where they're putting in a combination of office and room supply. The office supply will create demand, reduction in room supply will again be favorable for the industry. But and for the short term, both supply and demand have collapsed. But from a mid to long term, clearly it is beneficial because supply doesn't come up overnight. It takes years to build supply out. And if some projects have dropped out or slowed down, their restart, remobilization, and then building it out and opening it up will take several years to come back. So for the next 4 or 5 years, as demand comes back, this is certainly a favorable situation for everyone, including us. So the favorable part I've answered. What was the third question? On the distress opportunities. Yes, we believe that There could be distress opportunities in the market. They are not currently as strong as people think they are for 2 or 3 reasons. People have taken advantage of the loan moratorium or the interest moratorium. Some of them are banking on the one-time loans restructuring. So there was capital available to people for 2, 3, 4 quarters, and largely the bottom of the barrel is being scraped out right now. But in 1, 2, 3 quarters, we do expect an increase in distressed assets in the market. We will keep our gunpowder dry and, of course, take prudent financial decisions when such opportunities arise.
Thank you. That was really helpful. That's all from my side.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Aditya Bagul from Axis Capital Limited. Please go ahead.
Hi, thank you for the follow-up opportunity. 2 questions. First, just wanted to understand, your interactions with other Marriott and IHG affiliates. What are they saying in terms of business travel, both domestically and for Asia Pac? If you can just talk about a little bit of readings from that would be helpful. And second, Milind sir, we talked about the loan sanctions from HDFC and IFC. I think the total amount will be 350, 400 odd crores from IFC and about 500 crores from HDFC. If you can just indicate what would be the interest rates on that.
So I'll take the first part of the question on the engagements with Marriott, Accor, and a lot of other brands also. It's not just our engagements are not restricted to Marriott and Accor in terms of understanding what the market dynamics are. We've been discussing with people from domestic brands also, Puneet and everyone else. I did read out the sort of companies that have started using our hotels, and I only listed out top 5 accounts in the recent months and weeks at each of the hotels. There are many more, right? So business travel is happening. We see the demand picking up. 2, 3 things that we are looking at is which company has opened out their travel portal for their employees to travel, 1. 2, which companies are the ones which are high growth companies or industries which will need business travel to close deals, meet clients, train employees, etc. 3, we're looking at the mix of domestic and foreign companies. When I say domestic, I'm including MNCs based out of India, and there's a large number to be catered over there, and companies that travel in from outside into India. Looking at all of them and understanding what their future travel pattern is likely to be. The general indication that we've got from MNCs in India and domestic companies that business travel is being opened out as we speak now for their employees. So the travel portals have been opened up for them to apply for travel approvals. From the international companies, they're raring to come here. Unfortunately, the business visas haven't been opened up. And as soon as the business visas open up and airlines are allowed to come in on a regular basis, right now they're only restricted usage of those airlines, we see traffic picking up.
Aditya, let me clarify first. The sanction from IFC it is in principle approval, subject to due diligence. The indicative rate is 8 to 8.2%, and for HDFC loan it is 8 to 8.5%.
Understood, sir.
Aditya, but this is work in progress. We haven't closed it yet. We'll obviously try and push for as good as possible.
Sure. But cumulatively, even if this happens over a period of the next 6 months, this is enough to fuel the capex requirements in the next 2 years and any repayments which will come through. So liquidity per se is not going to be a challenge, is what I understand.
So in our case, we've never really had that liquidity challenge in the last 9-10 months. If you recall, we did not even consider taking the interest moratorium. We have not pursued the one-time loan structuring. In fact, we didn't even, frankly, look at it because we didn't see the need for it. And an outcome of that is that we've been able to keep our credibility with the banks high which has resulted in very good drop in interest rates.
Sure, sir. Sanjay, just one last question. From the way we're looking at things today and through your management, through commentary that we heard across the hoteliers, is it fair to assume that FY23 will look very, very similar to what we saw in FY20? Is that a fair assessment to make?
Yes, I don't want to give forward-looking numbers, but I think, yes, we will, on an apple-to-apple basis, we will be similar numbers. As far as revenues are concerned, you've got to keep in mind that 2 hotels will be added to the portfolio.
Yes, of course.
Novotel, which got added in February of 20, and then the Hyderabad, which is likely to get added. Between them, they have almost over 400 rooms, and if we add the 88 rooms, close to 500 rooms added to that, to the 20 numbers. In addition to that, there will be stabilization of the Sahar office asset, which was partially there in 20. And finally, we will be operational in Bangalore and almost operational in the Powai office building, which is 750,000 square foot leasable space.
Understood, Sanjay. Thank you so much for your comment and best of luck.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Amit Jain from Ivy Cap Ventures Advisors. Please go ahead.
Hi, this is Gaurav Punjabi, Amit Kandi. Just wanted a quick question. I just want to understand your strategy when you are looking at the rentals. Are you looking at volume business as of now, improving the occupancy, or you're happy keeping, because the average room rates have dropped from almost 8,000 to 4,000. And I was reading a report, because of this price drops taken by 5-star hotels, almost most of the 4-star hotels and 3-star hotels will be out of business because that was their average revenues. So what is the strategy you're pursuing as now? Are you looking at higher occupancy, keeping the rates low, or do you plan to step up rates and eventually, maybe be happy with like a 40-45% occupancy?
Well, it's like this. When you are in a situation like we've been in for the last 10 months, clearly the strategy is to fill out rooms. Our business, as far as room business is concerned, is perishable in nature. The crisis that we've seen has never been seen before, and the priority was to fill out rooms. Also, what happened was the regular segments of business were not available at all. So what did you go to? You went to such different segments of business. Group travel, large groups traveling in from outside India into India and staying for 2-week isolation purposes. Government had fixed those rates. We had doctors staying from BMC in our hotels. Those are obviously extremely low rates in the early part of the quarters. We had BCP, which is a business continuity plan from various companies staying at our hotels. For 2 months in Hyderabad, we had almost 250 rooms occupied by a couple of companies. Now, these were people that had been put up in our hotels because our hotels next to offices, so it was walking distance. So it's basically walk from hotel concept into office. And all these segments were clearly new segments, and therefore they were negotiated afresh as individual negotiations as against annual contracts. And in the recent days across the country, there's been a lot of hiring happening in various corporate houses, whether finance-driven or IT-driven corporate houses. And a lot of the new joinees, which used to earlier stay in 3, 2, and 4-star hotels, the companies prefer putting them up in 5-star hotels because of safety reasons and hygiene reasons. And as an outcome, they came to us and they said, listen, we'll up the rate that we were paying earlier, say last year, but we still can only afford a certain amount. Will you take them? And it was our call at that point of time to whether take that at that rate and fill up the rooms. As long as it was, from a margin perspective, value accretive, we've taken business. The other thing I think I would like to add is, which is a significant movement, is the food and beverage business. On food and beverage business, we've seen a very rapid jump. As I had said earlier, our jump in F&B has gone up from September number of 27 million to 118 million in December. And that clearly indicates that F&B is going to pick up. This is without banquets really kicking in. This is largely restaurants and bars. So we see a significant move from standalone hotels or standalone restaurants to five-star hotels for F&B also, which again is a positive. A couple of other segments I want to share with you, which are interesting, and then again become segments forever for us in future during the valley periods. Are segments like film shoot, for example, our hotel in Powai has done quite a few film shoots, and some of them were very large values in terms of invoicing. And then we've had special purpose sports groups like in the Mumbai Indians and other cricketing groups staying with us pre-IPL. We now have another group staying at 4 Point Sheraton from cricket. So all that's happening. Now, as I said earlier, these are new segments getting developed, and they'll only help top up old segments when business comes back to normal. So we see a strong future ahead.
Thanks. Just one follow-up question. The banquet revenues, where do you record it? Is it in the F&B or is it in the room or is it in the other space?
No, banquet revenue is always recorded in the F&B revenue.
Okay.
See, there are 2-3 things I want to highlight here, and I think it'll be helpful for everyone. And when we do our revenue breakups as per the acceptable uniform accounting system, the room revenue, when it comes in, is obviously netted off for taxes to begin with the GST. And then the total the revenue that comes in, we take out meal credits. So if you include breakfast or a lunch or dinner, there's an allocation for each of these. And we take that off and we call that the net average room rate or net ADR. 99% of the global companies report net average room rate. We report it like that too. Okay. If you report it as gross, then it adds to the room revenue and therefore can take your average room rate and RevPARs up. But we take out all our F&B revenue from the packages that we have and credit it back to F&B. Within the F&B, the segments that we have are restaurants, cafes, coffee shops, bars, room service or in-room dining, and banquets. Within the banquet segment, you've got social, corporate, division. In social, we have weddings, we have birthday functions, any other parties that are thrown. And in corporates, we could have things like exhibitions, conferences, incentive meets, annual results, etc. So this is a quick overview. Then we have other revenue segment, which is basically revenue segments like spa, the travel desk, telephones, internet, and all that comes under that.
Understood. Thanks a lot. That's it from my end.
Thank you. The next question is from the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Thanks for the opportunity to follow up question. I'm not sure if this question has been asked. I just want to know your capex for FY22 and FY23. Secondly, I also want to know what is the status of construction of the office space which is building out. When is it expected to start operation? Thanks a lot. These are 2 questions.
So capex for 22 will be somewhere in the range of 550 crore rupees, followed up with capex of 275 crore rupees for FY23. And then we have normal repairs and maintenance capex of hotels, which is a small amount. And we expect to commence operation in Bangalore commercial office by FY23.
So end of 22, Bangalore will be completed and construction, and end of become rent yielding in beginning of FY23.
Right, and Powai? When is Powai expected?
Powai FY24 to start. It will become operational.
So this is conservative case scenarios. Right now, we are looking at March 22 end for Powai. We are today, as we stand, 2 months ahead of schedule. We may be able to improve that further and close, but I don't want to commit to that. So right now, in all our conversations, we are suggesting that you take commencement of rentals in the beginning of FY24 for Mumbai.
And have you been floating this space around to people? Have you had interest for pre-leasing? Any pre-leasing which is being done for these spaces?
Yes, we've got strong interest for both the sides. Obviously, it's too early. Typically, you start tying up, a little closer to the end date because then you get the best rent yields. So we'll try this up roughly around 5 or 6 months before completion of projects.
Sure. And just quickly on the maintenance expense, how much is the normal maintenance capex per year?
So it ranges between 25 to 30 crore rupees a year.
This is normalized year, not in a pandemic year, a normalized year.
Well,
So this year we are okay.
so our budget and our forecast for next year is 12 crores.
12 crores. Okay. That's all from my side. Thanks a lot.
Thank you.
Thank you very much. Ladies and gentlemen, that was the last question for today. I will now hand the conference over to Mr. Sanjay Sethi for closing comments.
Thank you so much, ladies and gentlemen, for joining us. We are just as concluding remarks. We are a lot more confident than we were about 3 or 4 months back. I think one thing that's given us confidence is that the vaccine, which we were expecting rollouts to happen sometime in April, started getting rolled out in January. So in our own internal thinking, I think we've got a 3-month head start on the vaccine front, which overall gives us an overall positive scenario. So we wish you well, stay well, and we look forward to engaging with you as and when we get an opportunity to meet you. Thank you.
Thank you very much. On behalf of Chalet Hotels Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.